Good morning, ladies and gentlemen. Well, by my calculations, the manual calculations, the risk dial now is at minus 35. So the spreads, and don't forget that this risk dial is based purely on spreads. It's not based on the price action in SPX at all. So the spreads are confirming the risk off. And we are very, very much in risk off, which basically means that SPX should be going down and testing all the support levels that I will give you later. I'm afraid that with these news about the extreme likelihood of Russia invading Ukraine, the yield curve is not going to be of much help for the next couple of weeks, simply because people will be getting out of their positions and they will be stopped every which way. But the point remains that the bond market will be the safer place to be for the next couple of weeks, but probably not for the next month or so. So we are going to see extreme volatility in all asset classes, and I will now try to explain to you exactly why. This is in inflationary terms could be an additional inflationary shock. So it could very well end up that the market that really suffers is bonds at the end of the day. But it's going to take a while, and I think in the meantime equities sell off without bonds, but then bonds catch up and then some. So extreme volatility for the next few weeks, and we will examine each sector now in detail. For the past several months, the yield curve has been telling one story, and that is extreme flattening. This is the 2s10s in the US, and my target was here in the mid-50s. We've achieved that target. I was talking about it for when we're here, just above 100. So what is likely to happen? Two-way action. Very extreme two-way action. I wouldn't be surprised to see 75, and I wouldn't be surprised if we ended up after a few weeks of trading higher when people get out of positions, all the way down to zero or even negative. War is inflationary. What you have to think about is what the end result of everything will be. Let's face it, and I'm going to talk about geopolitics now. If a country assembles 150,000, 200,000 troops to invade a country of 40 million with an army of 250,000, which has much better supply lines because they're shorter, it signals to me that it's going to be a limited campaign with limited objectives. Now, what could the objectives be? The objectives could be just to secure the Russian-speaking eastern part, somewhere to the Dnieper River, and basically secure the water supply to the Crimea. That should mean that the war is over within a few days. And then the really secondary effects happen. The secondary effects are inflationary. Russia supplies a lot of, and I tweeted this out, I retweeted it on my public feed. Russia supplies a hell of a lot of rare, or not rare, but limited supply metals, which are very important for semiconductors and all sorts of industries. I think the world price is likely to rise, and that is inflationary. And so it's inflation on top of inflation. So that is what war does. It it increases the cost of energy, it increases the cost of raw materials. That is all inflationary, and that is something that the central banks eventually, after the flight to safety or whatever you call it, after people have got out of positions, that is something that the central banks are going to have to address. And the only way they can address it is through higher rates. So to me, the end result is going to be one of a flattening yield curve, which signals recession. That is all I can say. That is the only thing that makes sense to me. So if you see violent moves up to the upside to around the 75 area, I think it's going to be a great point to buy puts on the 10-year note. And I will tweet it out as it happens. It's going to be very volatile because, as I told you, people will be stopping out of positions in everything. As to the other parts of the yield curve, 530s on a weekly, that is a trend, right? Could it come back? Yes, of course. But the trend is unmistakable. The trend is showing that the market is pricing in a recession at some stage. This is this is the 10s, 30s. This also, would I be surprised to see extreme moves? No. But at the end of the day, this market is showing that we are heading towards a recession of some sort. I don't know how to sugarcoat it, and I see no reason to sugarcoat it. I think that we will see some extreme moves. Would I be surprised even to see a move back down towards 56? No, I would not be. But I think that when we see extreme levels, and I'll be tweeting out those as we go along over the next couple of weeks, is going to be a great point to buy puts in the longer term, in the longer term bonds. It just is. I really think that it's going to be extremely volatile for many reasons. People are going to be stopping out of absolutely everything. Now, this is 5s, 10s. We've gone through, even with the news, we've gone through the previous highs. That suggests that the yield curve is going to eventually invert in the US. I really would not be surprised to see a flat to inverted yield curve around 2.5% at some stage. All that can be said. If we look at the individual tenures, before the news came out, we were right up here, and don't forget this is a weekly chart, and we came right back to resistance at this 1.87%. I really wouldn't be surprised to see a move even down to 145, okay? But then a very, very accelerated move. We will play it through options. That's all we can do. It really is going to be very, very volatile. It really does say that we are headed for a period of inflation. And if we're headed for a period of inflation, eventually the yield curve might well settle at these levels where we were in late 2018. It really could do. If we have a look at 10s, now this is a weekly chart, you can see where we were. We were breaking through this very important level here, just over 203, and we came back. To me, eventually, when we tested these lower levels around 169, we can easily go up into the 230s, or even 250, which is basically the objective. It's going to be very, very volatile, but the main eye on the prize is the inflation that's going to be generated. Wars are inflationary, sanctions are inflationary. So to me, the upside move is the one which will eventually win out after we've had everyone being stopped out of their positions. To me, 230, 250 is going to be our target in the 10s. If we look at the 30s, which is the one I'm least bearish on, because I think the yield curve eventually inverts. Could this be signaling a move to 250 to 270 eventually? Absolutely. Could in the next few days, could we come down to 207, something like that? Again, options, long-term options for a move higher. I just don't see any alternative to higher rates, especially higher short-term rates, which eventually squeeze inflation out of the system. Even more volatility than in the US is going to be seen in Europe. The first response is going to be that the ECB won't be able to raise rates, which is precisely the wrong response, because the ECB is going to have to raise rates because the inflation is mostly going to be seen in Europe because of higher energy prices and higher raw material prices, exactly what German industry needs to produce the components and the manufactured goods that it produces. Germany is a manufacturing country. So, could we see a move in the Schatz all the way here to minus 49? Easy, okay? Easy. Don't forget that these closes that I'm going to show you are the closes before the news broke and before the market broke. And we could easily come down to even minus 58, minus 59. That is going to be a gift for us for longer term options for the upside. What the market does in the short term, I really don't care. And this, is going to be this is going to be even 112. So to me, you don't do anything Monday or Tuesday. You let the market settle and test some very important levels, and only at important levels that I'm mentioning here, and you can see them, and I'll put them in the trade sheet. Those are the levels that you want to do some puts in the futures for much higher levels. If we change this to a 5-year note, and don't forget this is where this is the bubble and this is where it closed on Friday, could we go all the way down here to minus 31? Easily. I think the German yield curve is actually going to steepen. I think the 2s are the ones that are going to go down in yield most, because that's the flight to safety, and the 10s the least, because the 10s are going to start thinking about inflation. So on the bubble, could we see minus 32? Absolutely, in a heartbeat. But that is where you start putting on your puts for the longer term. If we look at the Bund, this is the one that I think is going to react the least. I think the curve is going to steepen in Germany. We could easily come down to even from plus 29. We could come down to 9 easily, and we could easily even go down to minus 4 in terms of yield. Easily could we go to negative again. So these are very big moves, and I think you will see them in the course of 1 or 2 days. But for the longer term, they're going to be much better levels to get in via puts or however aggressive you want to be. But these are the levels that you want to trade. You don't want to trade at any other level. Well, the US dollar gave away the game when it wouldn't break 95.07. And now I would have thought it's, 96.47 is probably a given, and probably 98.54. When do you want to short the dollar? Well, you probably want to short the dollar as soon as the fighting starts. I think, as I said, I think it's going to be a very limited campaign, and I think the flight to safety is going to be over soon, or rather quickly after the fighting starts. The risk reward is to basically sell the dollar when the fighting starts, within a few hours of the headline that they have started invading. If they don't invade, then it's going to be what the market does at 95.07. To me, that is obvious. If we start breaking through 95.07, we have room down to 93.63. But it's not going to be it's not going to be a one-way street. I think it's going to be a one-way street on the upside as the fighting starts up to 98.54, but I think that is going to be a wonderful level to buy puts on DXY. I also wanted to show you a monthly chart. This is now a monthly chart of Euro USD. And show you how it doesn't really like to stay below the Bollinger Bands for very long. It does spike them and it does come back. You can see it here, you can see it here, and you can see it here. There's always a reaction. It has to sit on the Bollinger Band to start opening it up. To me, this signifies that really the likelihood of us staying much below is not great. So if we go back to a weekly and a daily, what does that imply? It implies, can we go back down to the lows? Yes, we can, but it's unlikely really to start breaking down much more than that. And that to me makes sense, because it's going to be, if it's going to be a limited campaign, and I can't really see how with 150 to 200,000 troops in a country which is vast and huge and has 40 million inhabitants and an armed forces of 250,000, with 150,000 troops, you're going to mount a limited campaign. Russian troops are much better armed, much better prepared. So it's going to be a limited campaign. It's going to be over within 4 or 5 days, hopefully. And that is going to be the signal for the end of the dollar buying. Gold, of course, had the reaction, the knee-jerk reaction up. Gold is actually the one I'm least bullish on, simply because I think the Russians might have a lot of gold to sell. If, very stringent sanctions are imposed on the Russians, and they reduce the supply of gas to Western Europe, what are they going to sell to finance themselves? Well, gold is an obvious one. They have, lots of mines, and whether they do it via, Turkey, and they smuggle it out and they sell it, they're going to find channels. I mean, you're talking about people who have been smuggling for thousands of years, and who are allied with the Chinese and they're allied with the Iranians and, the Turks to a lesser extent, and via Armenia or Azerbaijan or wherever, they're going to have, find a way to smuggle gold. I mean, if the US thinks that they're not going to be able to smuggle anything they want to smuggle, they're stupid. So, will gold keep on going? And don't forget that we closed up here. Yes, 1881 and beyond that, we've got the 1950s. But to me, we are at the top of the weekly Bollinger Bands. Can we go through the weekly Bollingers? Yes, but we're going to come back. So somewhere around 1912 to 1950, 1912 to 1950 is where you want to definitely not own gold anymore. If you've got it, to me, it's not going to be the one that's going to remain higher, because tensions ease, wars end, and the resulting inflation will be squeezed out by the central banks. And I think, as I showed you earlier, bonds fall. And if the dollar doesn't go up and the bond yields go up, then I don't think gold is the one that you want to be in. Really as simple as that. If we turn to DBC, which is the one that I've told you is the much better hedge than gold, you will see that we are getting to my objective here at 24.39. Can we get there next week? Absolutely. Could we exceed it by a bit? Absolutely. But I think here you want to get out. Yeah, 24.39, you don't want to be in DBC. And as you can see, this chart of gold over DBC, it didn't move at all. It didn't move at all on Friday. So we're getting very close to my longer term level. I think what that would suggest to me is that DBC is going to get to its target. Gold goes up, and then gold falls back less than DBC does. So to me, that is what is more likely to happen than not. If we go to the DBC chart, risk reward here is definitely to get out of the longs that you've had, well, all the way from here, basically. And the other thing that we have a look at is oil, which broke up, but not very much. And we are very close to my 97 target. I think here you basically abandon oil and you say this is going to be a limited campaign, and you get the hell out. The other thing that war is good for is volatility. So inflation and volatility are the two things that it's good for. And therefore you can forget about looking at SPX charts and the X charts. All you need to look for is volatility, where volatility is trading. Now, to me, it's very obvious that volatility has ranges that it likes to respect. We just cannot break on a closing basis below 22.51 on a weekly chart. Every time that we trade down into the 20s, we go straight back up, and we go straight back up to the top of the 31.05 level that I think is so important. When you do not want to be short of volatility, certainly not before the fighting starts. If I'm right and it's going to be a limited campaign that lasts, I don't know, a week or something like that, volatility will lead the upside and volatility will lead to the downside. Can we easily, if it starts trading above 31.05, we could easily get to 43. That to me is the line in the sand, that if we go above there, some very nasty things are going to happen. To me, 43 is going to be the key level. I think at some stage we definitely break 31 and go up to 43. So you definitely want to be long of volatility, and you never want to short volatility before this is over. But what I'm saying is that volatility will very likely show you the top. Okay, very, very likely volatility will start, will spike and then will start coming down before XPX starts coming down. And that will be your signal, and I will tweet it when that happens, that the market is now basically going to retrace. If we have a look at it on a daily basis, you can see how important this level here around 40, 41 is on a daily basis as well as the weekly. I think it's very likely that we test it, which basically means some downside in SPX over the next few days. And I think it then does one of these things. it basically comes off as the fighting starts. I think the top is going to be somewhere when the fighting has started, or it becomes obvious that the military aims are limited and that they're not taking major cities, that they have no interest in taking major cities. With a force of 150,000, I don't really see how they can even hope to take a city of 1 million or 2 million. I mean, and the Ukrainians have several of those. How do you do that? You need much bigger forces. So I think if it does happen, it's going to be limited. It's going to be limited to taking territory and securing territory around the Russian-speaking eastern part, and securing the water supply for the Crimea, and basically tidying up the border of Russia and Ukraine, basically making Ukraine slightly smaller and making the positions that the Russians hold the positions that they want to hold for the future, and then some kind of a peace treaty which completely separates Ukraine from Russia. I think the Russians have realized that Ukraine is a lost cause. This is an interesting table. I will leave it here for you to look at. To me, we are in a new era. I think these days, on average, to a bottom are going to get less and less and less. I mean, if you have a look at Pearl Harbor, 140, yeah, but that was a world war. Nobody is talking about a world war here. So really, you are looking into the single digits. Okay, you're looking into the single digits, and the recovery also. You're looking into single or double digits at most. So maybe one of the good ideas is, because we don't know when it's going to start, and nobody's really going to start buying markets before it started, and maybe not even after a couple of days after it started. I think the market needs to see and be convinced that the Russian objectives are limited. I'm convinced that the Russian objectives are limited, even if they do go in. But maybe the easiest thing to do is to sell some calls, because the market is not going to rally until something's happened. Therefore, maybe selling 1, 2, 3 day calls and keep on rotating them is probably not a bad idea. I'm going to leave this table for you here. Do with it what you think is best, but I think that this is far too long, and it's actually skewed by Pearl Harbor, and the quicker the information is relayed and the technology advances, i.e. that the more modern times, the bottom tends to be within single digits of the event. Without a doubt, the largest impact should be felt in the countries that border the conflict. As I said earlier, the effects should be by far the largest on Germany and Europe as a whole. So really what makes sense is to look at what those markets are saying. This is XPX on the left and DAX on the right. I'll talk about each one in turn. So if we say that this is going to be some kind of a 3-wave move down, and if we look at where the really important levels are, it matches. The 100% move happens to be at 38.44. That is what I think is likely to happen. I think stocks is likely to go down to 38.44. And if we have a look at the same in the DAX, I'll enlarge this so you can see if we have the same kind of ABC, where does the 100% move come in? 14,280 odd, and can it go down to 14,000? I will zoom out and see why this 14,000 level here is so important. Well, the highest close of this move okay, is 14,072. We can leave the line there. Whether it's 14,000, 14,072, who cares? But that is easily the kind of move you could see, and that is where it stops and bounces like crazy. That to me is the likelihood. Okay, so really the first line of support is 14,760, and after that 14,072. It makes sense that these are the markets that are going to be affected. It makes far more sense than selling SPX. I mean, what SPX, if anything, is going to have some beneficial effects because the US is going to sell more gas to the Europeans. The military-industrial complex is going to be funded to produce another 100,000 missiles that they're never going to use, etc., etc., etc. So to me, selling Germany, which is not going to be able to sell because of the sanctions that are going to be imposed, that's not going to be able to sell stuff into Russia, the German banks that are hugely exposed to the Russian banks, etc., etc., etc. I really see no logical alternative to being, if you want to be short of equities, to being short of being short of stocks and being short of DAX rather than being short of the US. This is SPY EWG on the left and EWG over EWJ. So that's Japan. This is Germany, Japan. So which to me is going down. And this is the US against Germany, which is going up. These closes are all wrong because basically they happened before the news kind of thing. To me, this is likely to go up and break the highs. We're still down on the year, okay? So this is where we closed the year. So to me, it's natural that we go and break these highs here and try the all-time highs. And also, this trend is very much down for EWG over EWJ. So you could consider buying Japan and selling Germany as a flight to safety trade. If we look at SPX last, because I don't think SPX is the problem. Do we probably go and test the lows over the next few days, or at least this 4320 kind of level, 4300, just below 4300? I think it's probably possible because people need to get out of positions and we are in risk off. But I really repeat, I just don't see that this is a US problem. I mean, the US is so far away from the conflict and stands to benefit financially, apart from the inflationary aspects, that I really wouldn't be all that worried about SPX. The action should not be here. The action should be in other exchanges, but it'll come off in sympathy. There's absolutely no doubt about that. If we have a look at my favorite timeline, to me, this is basically a grind lower to around this 4317 or just below it, 4300 over the next couple of days. And then if the invasion does not happen, actually the bounce is going to be most limited in SPX, and there's going to be a huge bounce in Europe. Unwinding of the trade, which is, I think a lot of people are going to put on over the next couple of days, which is short DAX, long SPX. And that will be unwound. But I just don't see that this, that this is a bullish chart, and B, that anybody is going to be buying it until at least the fighting starts. So the path of least resistance is still going to be down towards this 43.17, 4300 area, and then below the very, very important 42.55 to 42.32 area. I don't know what to make of NQ apart from say that it's just as bearish as SPX, but it really doesn't feel like the action should be in NQ. Let's face it, the technology sector, what does it respond to? It's a duration sector. It responds to bonds. But in the short term, bonds are going to be capped because of the uncertainty, the flight to safety, etc., etc., etc. So it really should not be the one that's responding in the short term. Plus, if there is some sort of a conflict, there's always the prospect for more military contracts for new technology, etc. It makes doing business over the internet more likely rather than less likely. I just don't see that the action should be particularly in NQ. It's not the one that's really going to be affected by anything. And therefore, I just don't see that it's particularly important at the moment. Will it keep on coming down because we're in risk off? Yes. I think to me the critical level is 13,816. If we keep on closing above it, we are still holding in. We go below it, we will go down quite a bit. If we have a look at what's happening here in the the 195-minute chart, basically it's touching. This target was touched. On the upside, that target was touched at 100 and 138, and now we're going down. I think we are likely to retest this 13,700 area, but I don't think the action should necessarily be in NQ. So it's not the one that I'm going to look at to give me any kind of a lead. I think EM is going to be better for and volatility is going to be a much, much better leading indicator than NQ is. I think EEM is going to start being a bit of a leading indicator as to how stocks are going to trade, because EM still closed slightly up on the week, and if the dollar's going to get bid, you would have thought that EM would suffer most. But we're getting to levels, this 47.93 and 45.04, which are going to be extremely, extremely good support. And that is telling me, if they remain really good support and EM does not break these levels over the course of the next several weeks, that will tell me that basically the move down in EM and in equities general is being exhausted. So I will look at EM as a leading indicator because that makes sense to me. If the dollar's not going up anymore, well, there has to be a reason for that. If emerging market equities are not being sold on the back of higher inflation and therefore ultimately higher bond prices and etc., 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 that changes a narrative. That changes a macro narrative. And to me, if we don't close at any stage below 45.04 and it keeps on bouncing off there, that is good news for equities for later on in the year. Right, so on to the summary sheet with the levels. I've updated them. I think, just to stress how extremely volatile European bonds are going to be next week. I think you really want to only trade them at levels. Have a look, rewind back to the charts that I showed you in Schat, Bund and Bobble, and look at those levels. They're miles away from where the market closed in Germany. Don't forget that is where it closed in Germany, and is going to reopen somewhere completely different. So we will only trade them at levels, and it might be that options are the safest way to trade them. We will see what the pricing is, and I will tweet those as the day goes on. As far as equities are concerned, I think that DAX and stocks are the ones that are going to show you the way with VIX. Okay, and the VIX is the one that I think is going to tell the story, and also the differential between VIX and stocks. The more the differential goes up, the more the pressure is going to be on stocks rather than on SPX. The levels are there. All I can say is the fact that we revisited the scene of the crime and slightly higher and then failed there several times tells me that the whole of the equity complex is for sale anyway without this Russian crisis. That is just the extra bit of oil which is being poured onto the fire. The whole direction of equities for the time being is down, but it's being accelerated. To me, the VIX and the EM become leading indicators of what is going to happen. Thank you very much indeed, and tweet you on Monday. And be safe, and just only trade at levels. The volatility is going to be very, very high.